Hi, I'm Gerald Munoz and I will discuss to you the part of the chapter 19, which is the international financial issues. So in this section, we will discuss some of the important treasury functions including the capital budgeting, cash flows, and global cash management, and also the foreign exchange rate risk management. First, we will discuss to you the capital budgeting in a global context. So capital budgeting is the process whereby multinational enterprises determines which projects and countries will receive capital investment funds. So the parent company must compare the net present value or internal rate of return of potential foreign project with that of its other projects around the world to determine the best place to invest resources. So here is the method of capital budgeting. So the capital budgeting, there are capital budgeting techniques. The the payback period, the net present value of project, and the internal rate of return. So payback period. One approach to capital budgeting is to determine the payback period of a project or the number of years required to recover the initial investment made. This is typically done by estimating the annual after-tax free cash flow from the investment, determining the present value of the future cash flow for each year, and then determining how many years it will take to recover the initial investment. So, a second approach is to determine the net present value, or we call the NPV of a project, which is defined as follows. Here is the formula. So NPV equals C. N equals T1 equals FCF T over 1 plus Q T minus IO, where the FCF means is the annual free cash flow in period of time. So the key is the appropriate discount rate, that is required rate of return or cost of capital, while IO, the initial cash outlay, and the N is the project expected life. So here, the third one is the internal rate of return. A third approach is to compute the internal rate of return, or what we call the IRR of the project, the rate that equates the present value of future cash flows with the present value of the initial investment and compare it with the required rate of return. If it is the greater than the required rate of return, the investment is considered positive. However, the company then needs to compare the IRR with the competing projects in other countries. So we move to complications in capital budgeting. Several aspects of capital budgeting are unique to foreign project assessment. First, we have the parent cash flows. Second is the remittance of funds to the parents, such as dividends, interest on loans, and payments of intra-company receivables and payables, is affected by differing tax systems, legal and political constraints, and the movement of funds, local business norms, and difference in how financial markets and institutions function. In addition, tax systems affect free cash flows on the project, irrespective of the remittance issue. Then, differing rates of inflation must be anticipated by both the parent and the subsidiary because of their importance in causing changes in competitive position and cash flows over time. Then, the parent must consider the possibility of unanticipated exchange rate changes because of their direct effects on the value of cash flows and their indirect effects on the foreign subsidiary competitive position. Next is the parent company must evaluate political risk in a target market because political events can drastically reduce the value or availability of expected cash flows. Last is the terminal value. Okay, so internal sources of funds. Although the term funds usually means cash, so the funds are working capital or a current assets minus the current liabilities. So it is used in a much broader sense in a business and generally refers to working capital. That is the difference between current assets and current liabilities. From a general perspective, funds come from the normal operations of a business like selling merchandise or services, as well as from financing activities such as borrowing money, issuing bonds, or issuing shares. They are used to purchase fixed assets, pay employees, buy materials and supplies, and invest in marketable securities or long-term investments. So there are sources of internal funds like loans, investments through equity capital, intercompany receivables and payables, and dividends. So here is the cash flows and the multinational enterprises. Cash flows in the multi-international enterprises are significantly more complex than for a company that operates in a strictly domestic environment. An MEE that wants to expand operations or needs additional capital can look not only to the domestic and international debt and equity markets, but also sources within itself. The complexity of its internal sources is magnified because of the number of its subsidiaries and the diverse environments in which they operate. In Figure 19.8 shows a parent company that has two foreign subsidiaries. All three may be increasing funds through normal operation that may be used on a company-wide basis, perhaps through loans. The parent can lead funds directly to one subsidiary or guarantee an outside loan to the other. Equity capital from the parent, another source of funds for the subsidiary. So in this figure 19.8, then question is how the multinational enterprises handles its funds. So the answer is the internal funds. So funds consist of working capital that comes from normal business operations and that may be used to purchase assets and materials, so to pay employees and to make investments. If the company is an multinational enterprises, funds may come from either parent or subsidiary operations or both and can be used by the parent to support either its own operations or those its subsidiaries. Here is the figure 19.8. See the parent company to the different subsidiary and the original subsidiary, the dividends, royalties, and fees, the guarantees, loans, the extension of accounts payable, and invest more investing here. Global cash management. To ensure the effective cash management, the CFOs must determine these questions. What are the local and corporate system needs for cash? How can the cash be withdrawn from subsidiaries and centralized? And lastly, once the cash has been centralized, what should be done with it? So here it is shown in the figure 19.9 how the multinational enterprises handles its funds. The answer is multilateral cash flows. So as the various subsidiaries of the multinational enterprises go about their business, cash can be transformed among them for a variety of reasons. Example, in the form of loans or as proceeds from the sale of goods. Cash, of course, can flow in any direction as if the multinational enterprises doesn't maintain some kind of cash management center. Its subsidiary must settle its account like receivables, payable, etc. independently. Here is shown in the figure 19.19 like this: the French subsidiary to Italian subsidiary to UK subsidiary and the German subsidiary. So a cash budgets and forecast are essential in assessing a company's cash needs. Then once local cash needs are met, the cash manager must decide whether to allow the local manager to invest any excess cash or have it remitted to a central cash pool. If the cash is centralized, the manager must find a way to make the transfer. A cash dividend is the easiest way to distribute cash, but government restrictions may interfere. For example, the foreign exchange controls may prevent the company from remitting a large dividend as it would like. Cash can also be remitted through royalties, management fees, and repayment of principal and interest on loans. So, a multilateral netting. So, multilateral netting is the process of coordinating cash inflows and outflows among the subsidiaries so that only net cash is transferred by reducing transaction cost. Here shown in the table 19.3 identifies the total receivables payables, and the net position of each subsidiary rather than have each subsidiary settle its account independently with subsidiaries in other countries. Many multinational enterprises are establishing cash management centers in one city such as Brussels to coordinate cash flows among subsidiaries from several countries. So how can it handle? But how can the multinational enterprises handle its funds in table 19.2? The answer is net possessions. So assume that these data are from the same multinational enterprises as this one introduced in figure 19.4. Because a company has no cash management center, net possessions, the difference between total receivables and the total payables, must be determined on subsidiary by subsidiary basis. This is a subsidiary, the total receivables and total payables, and the net position. This is the subsidiaries each country, total receivables there, total payables, and the net position. Here is shown in the figure 19.10 how the multinational enterprises handles its funds. So the answer is a multilateral knitting. It is dissatisfied with the process represented in figure 19.9. Our multinational enterprises have now established a cash management center or a clearing account into which each subsidiary transfers its net cash. Naturally, the multinational enterprises may in turn distribute the total to support subsidiary operations. Here, now, it's now clearing account from all the subsidiaries from French, Italian, German, and UK subsidiary. It is a clearing account, always clearing account. Then this illustrates how much subsidiary in the net payable position transfers funds to the central clearing account. The account manager then transfers funds to the accounts of the net receiver subsidiaries. In this example, only 4 transfers need to take place. The clearing account manager receives transactions information and computes the net position of clearing subsidiary at least monthly, then orchestrates the settlement process. The transfers take place in the payer's currency and the foreign exchange conversion takes place centrally. For knitting to work, the company needs to match its cash needs with the software and that can track and transfer funds and with banking relationships that allow money to be moved among corporate entities. So its knitting requires sophisticated software and good banking relationships in different countries.